This Week in Economics on the 10th of January 2016. Numbers Man here, and we'll be talking about demand, and we'll look at Apple, Apple being part of the Dow 500 index there, and one of the important tech indicators in the market. And we'll look at the job numbers, where they are, and we'll go to the Bureau there and their statistics, and we'll see where the working people of America are going, which industries are up, which industries are down. And we'll take a look at income inequality. New paper out from the economics convention out in California recently here, and there was an article also in the New York Times talking about income inequality, something that economists normally do not speak of. It is more and more to the front page. If you looked at any of the commercials for the various political campaigns, whether it be Mr. Trump or Bernie Sanders, constantly talking about income inequality, and we'll look at the study by a number of people here so we can get to it. Here we go, the study, and we'll put it on the show notes. This is there's a number of studies here. This is called the Pictet transition, a different study. This is not the one we'll be looking at here. This is a study of the effects of inequality on the Pictet transition to zero growth. And that is one of the recurrent things we will be talking about in future broadcasts. But in this particular broadcast, we'll do more, I suppose, mundane things. This is by Song, Pierce, and Nicholas Bloom, Center for Economic Performance, they call it. But it is about income inequality and the various machinations that surround it. There, everybody from Dean Baker at the Center for Economic and Policy Research. We have used them a number of times. And Thomas Piketty, we talked about Thomas Piketty, his Capitalism in the 21st Century was a best seller. He is a French academic. And they also won a MacArthur Genius grant for their work. And the Times had an interesting article here that came out of the Economists Take Aim at Wealth Inequality is the title of the article. It's written on the 3rd of January 2016, the American Economics Association. We'll return to it, but first we'll go to the job numbers, and then we'll get around to Apple. But let's firstly pull the data. They call it the Bureau of Labor Statistics. And this was on Friday, the 8th of January. And we'll get to it. The number of unemployed persons at 7.9 million was essentially unchanged in December. And the unemployment rate, of course, is at 5% for the third month in a row. Over the past 12 months, the unemployment rate and the number of unemployed persons was down 0.6% and 800,000 respectively. Amongst the major worker groups, the unemployment rate for African Americans declined to 8.3% in December, while the rate for adult men is at 4.7%, adult women at 4.4%. Teenagers, all too high at 16.1%, and for Europeans, 4.5%. Asians, 4%, Latinos at 6.3%. Showed little change there. So the highest, obviously, unemployment rate here is for African Americans at 8.3. Now that's the official rate. The number of long-term unemployed, something we look at, jobless for 27 weeks now or more, was essentially unchanged at 2.1 million in December, and accounted for 26.3% of the unemployed. So in other words, a little over 1/4 of the unemployment rate, the long-term unemployed, have shown a little movement since June, but was down by 687,000 over the year. A little over 500,000 people there. The number of persons employed part-time, very important. A figure here for economic reasons, sometimes referred to as involuntary part-time workers. A little change there. 6 million people in December, but was down by 764,000 over the year. These individuals would prefer full-time work, obviously, if they could find it. In December, 1.8 million persons were marginally attached to the labor force. That's down 427,000 from a year earlier. And it was not seasonally adjusted. They are not counted as unemployed because they have not searched for work in the 4 weeks preceding the survey. So a little different semantical gymnastics here. They're marginally attached. There are 663,000 discouraged workers in December, a little change from a year ago. So basically, you have over 500,000 workers that are discouraged. Now, the establishment survey, we've talked about the 2 different surveys they have. The total non-farm payroll employment increased by 292,000 in December. The employment rate in several industries, including professional, business services, construction, healthcare, food service, drinking places, mining employment continued to decline. In the 2015 payroll employment grew to a total of 2.7 million compared with 3.1 million in 2014. Employment professional and business services increased by 73,000 in December, with temporary health services accounting for 34,000 of the gain. In 2015, professional and business services added 605,000 jobs compared with 704,000 in 2014, a better year there. Construction showed a strong job growth for the 3rd consecutive week, gaining 45,000 jobs. Very unusual for December. Job gains occurred amongst specialty trade contractors, 29,000. In construction of buildings, 10,000. Over the year, construction added 263,000 jobs compared with 338,000 in 2004. In December, healthcare employment rose by 39,000, with most of the increase occurring in ambulatory healthcare services, 23,000 there, hospitals 12,000. Job growth in healthcare averaged 40,000 per month in 2005, compared with 26,000 per month in 2014, a better year in 2015 for healthcare. Food services and drinking places added 37,000 jobs in December. In 2015, the industry added 357,000 jobs. Employment in transportation warehousing rose by 23,000 in December, with a gain of 15,000 in couriers and messengers. Very interesting there. Within the information industry, motion pictures, sound recordings added 15,000 jobs in December, offsetting a decline of 13,000 in maybe November. Employment in mining continued to decline in December, down 8,000 after adding 41,000 jobs in 2014. Mining lost 129,000 jobs in 2005. So roughly there, 90,000 or so jobs lost. Manufacturing employment changed little in December, though non-durable goods component added 14,000 jobs in 2015. Manufacturing employment with little change, 30,000, following a strong growth, 215,000 in 2014. Employment in other major industries, wholesale, trade, retail, finance, government, changed little over the month. The average work week for workers in private non-farm was unchanged at 34.5 hours in December. Manufacturing work week edged down 1/10 to 40.6 hours. Overtime edged up 1/10 hour to 3.3 hours. The average work week for production worker was unchanged at 33.7 there. In December, the average hourly earning for all workers in private non-farm payrolls was at $25.24, unchanged very little there, an increase of 5 cents, following an increase of 5 cents in November. Over the year, average hourly, and this is average hourly, rose 2.5% in December. The average hourly earning of private sector production and workers $21.22 on change. A change in total non-farm payroll employment for October was revised from 298,000 to 307,000. The change for November was revised from 211,000 to 252,000. With these revisions, employment gains in October and November combined were 50,000 higher than previously reported. Over the past 3 months, job gains have averaged 284,000 per month. Now, previously we've talked about the to pull the slack out, you need to create between 300 and 350,000 jobs per month, and this is moving in more in that direction. So the employment situation is becoming much better than before. And now that was from the establishment survey. We have two. We have the household survey and the establishment survey. Revisions in the establishment survey effective with the release of the employment situation for January 2016. That'll be on February the 5th. The current employment statistics survey will introduce revisions on non-farm employment hours and earnings to reflect the annual benchmark adjustment for March of 2015. Update several adjustment factors there in April also. Now, changes to the household survey effective with the release on the 5th of February 2016. New population controls will be used in the current population survey, that's the CPS, of inter-central population estimates, that's from the Bureau, obviously, of the census. In accordance with usual practice, historical data will not be revised to incorporate the new controls. Consequently, the household survey for January of 2016 will not be directly compared with data from December of 2015 or earlier periods. A table showing the effects of the new controls and other major workforce series will be included in the release. Now, upcoming changes to the employment situation news, that'll be also on the 6th of February. We'll introduce changes there. The establishment survey will be published in addition to industry data, with the first preliminary release of monthly estimates. Employment situation table B anyway. Revision of seasonally adjusted household survey at the end of each calendar month. The Bureau of Labor Statistics routinely updates the seasonal adjustments. So you can look at some of these seasonally adjustment unemployment rates in 2015. In January of 2015, 5.7%, and it was revised, 5.7%, and in February down to 5.5%, March 5.5%, 5.4% in April, in May 5.5%, in June 5.3%, and in July 5.3%, in August 5.1%, 5.1%, in September, and then of course in October and November 5%. 4% these days is considered to be the norm, as one would say. Civilian non-institutional population here is some civilian, at 249 million here, and so forth. This was in 2014. In December, in January, as we go through the year, actually we ended in December of 2015 with 251,936. The civilian labor force was at 156,142. That was in December. And 2014. And if we start to look, the participation rate in December was at 62.7. In January, let me just get this right here. Okay. Anyway, basically where it is, population employed 147,000. There was in December. I see what they're doing here. Anyway, so these are some of the things that are included here, and this is employment status, and it break it up in the number of thousands. Here, women 20 and older, etc. Men 20 and older. 80,366. That was in December. The participation rate was 71.8. This is for men 20 or older. And then it has the number of employed, etc. Won't go into that. And for women, we'll look at the civilian labor force, 70,000, and the participation rate for women 20 and older was 58.2 there. And we won't get into people younger than that, but this is some of the numbers out here, starting there and going through 2015. Anyway, if we go to December, the last month of 2015, we'll get this chart right in a minute here. The labor participation rate was 62.6. So it dropped a little from December of 2014, which 0.7 temps, 0.6 temps are there. But the unemployment population ratio was at 59.2. That was in December of 2014. And in December of 2015, it was at 59.5. So improvements going along there. And if we look at the men 20 and older, civilian and non-institutionalized population, 113,241. That was everyone. And for men, it was 80,927. About the same. It dropped a little bit there. Anyway, this will do it for this part of it. The jobs picture. Jobs picture was in pretty good shape, actually. In the Reuters, dreadful week for stocks. Look for a reason to bounce as the investors were blooded in the year opening. In fact, this was the worst year opening for a number of years, period. Worst 5-day opening on a year record back to 1929. That was the Dow 500. Worst start of the year on record dating back the Dow Jones Index 1897. Several analysts already cut their earning targets, with Deutsche Bank reducing fourth quarter forecasts and admitting it was unsure how much to lower the 2016 estimates. Technical picture for stocks also deteriorated with the week's decline. The previous level of 1950 acts as resistance, while in August lows around 1870 there. Stocks could be positioned for quick but lasting rally. That's according to Jeff Salt, chief investment strategist at Raymond James. That's down in St. Petersburg, Florida. The outlook is not bright. Reuters data shows earnings for the fourth quarter expected to fall by 4.2%, down from 3.7% decline expected a week ago. These adjustments are continuing to be made, and even looking at the Chinese economy, indications are things are worse than some had anticipated. And the payroll growth, that was a tight picture. It's sort of interesting here. You start looking at, the market and where the actual jobs picture is two different pictures. You get to the iPhone here, and Apple had lost $80 billion of its market share. This is Apple Inc. in the first 4 days of the year. Several brokers' houses reduced their price targets in response to reports of slowing shipments of iPhones 6S and 6S Plus. You can only sell so many phones. The most bearish of the six brokers lowered their target. Let's see here. Coent and Company cut its target to 125. That's the price. That's 30%. 30% more than where the stock was traded on Friday. Apple shares were up 2.2% at $98.58. The median price target of $145 calls for a 50% increase in stock price. Remains a concern is China. China is the biggest market that Apple has. Still more than 80% of analysts have a higher recommendation. A mistake. Now expect Apple to increase revenue this year by less than 4%. This is a far cry from 28% achieved in the fiscal year ending in September. Well, those 28% days are gone for the time being. Apple's strategy has been to come out with new iPhones. They'll have an iPhone 7 out, and they want to boost sales by 40 million units in 2017. That'll be probably Q2, Q3 of this year's 16 that they'll come out with the new cycles. But if things continue as they are on a global situation, the types of growth that they have been realizing just will simply not materialize. We'll go now to the BBC, and we'll take a look at the business news here. We like to VW sales are down. One of the big stories here, sales dropped for the first time in 11 years. Well, they've had all kinds of problems. Sales of Volkswagen cars fell 4.8% in 2015 to 5.82 million cars from 6.12 million a year earlier. Falling demand in China and the U.S. Added to the losses in December. The underperformance of BMW's large division by sales and revenue pulled down the annual group deliveries by 2% to 9.93 million cars, the first drop in 13 years. Now, that is obviously to be expected. The scandal began declining after it in September. Deliveries fell by 5.3% in October, 2.4% in December, in November, and 7.8% in December. On Monday, the Justice Department filed suit against BMW Volkswagen for its emission test. You remember that saga? 2015, a record 17.47 million cars were sold, according to Auto Data. The firm keeps records since 1980. General Motors, one of the larger firms, had an increase of 8%. GM is back. Mercedes-Benz USA had its most successful year since entering the country, with rise in sales of 3.8%. The UK had a record for car sales also. The Society of Motor Manufacturers and Traders, 2.63 million cars were registered, beating the previous record in 2003. We'll throw this up on our Twitter feed. Incidentally, our Facebook pages are coming alive there, and we'll be Numbers Man will be at Cranston Analytics. You'll see that coming very quickly to you, and so we'll have the Facebook and Twitter feed. We'll also have a new Google Plus, and we'll change around. I think we'll make a change in our YouTube page. I'm not certain how we'll do that. We're going to be tinkering with some things. To Boeing here, while we're here, Boeing delivers record numbers of aircrafts. This is in 2015. Rival Airbus, we'll get to Boeing here, and Boeing delivered, beat its previous record of 723 in 2014. Last year, the manufacturer delivered 120 of its 737s in the first 3 months of the year, slightly below a target of 42 a month. Boeing has ramped up production of aircraft by 60% over the last 5 years. Production of the 787 Dreamliner, built with lighter weight composite materials that reduce fuel costs, rose 10% per month rate to 14 by 2020. Boeing also said that orders for new commercial aircraft fell to 768 last year from 1,432. Analysts, and that was in 14. Analysts expect Airbus to have won more orders than Boeing last year, with the European plane maker release data next week. We don't have it yet. As of December 31st, Boeing's backlog of orders stood at 5,795. So the aircraft industry is moving right along without, as they say, missing a proverbial beat. And returning to other items here, we covered the jobs. The Chinese billionaire is missing. We'll go to the UK and the savings rate there. Savings rate hits new low from the Bank of England. The average rate of individual saving account fell 0.85% in December, down from 0.99 in November. Instant access accounts, the interest rate fell to 0.48% from 0.54. Some individual accounts are paying savers as little as 0.01. That's from Financial Conduct Authority. The reason is the expectation that a rise in basic rates continue to push downward. Many analysts don't expect a rate hike, that's in the UK, until 2017. 6 lenders, Halifax, Lloyds, and Virgin Money, cut their rates in December. HSBC cut rate on Monday, the 11th of January. Many banks are offering higher interest rates on current accounts than on a savings account. So in other words, it is not the best of time for savers, as Mr. Nader was talking about. The oil industry continues to unload, and it is down. We'll go to it, and then we'll actually go to the market data, and then we'll come back and deal with income inequality. Briefly deal with it. We'll post it in the show notes, and we'll look at these markets now. This is Friday, unless otherwise noted. The BBC Global 30 was down 60.57 on Friday. The FTSE, we'll do the all shares. Was down 20.69. In Amsterdam, they were down 9.94 on Friday. The DAC in Frankfurt was down 130.51. In Paris, they were down 69.82. In Brussels, 56.73 in the negative. In Madrid, 150.10 in the negative there. In Zurich, 192.58 in the negative. Also in Moscow, they were down 5.56. In Johannesburg, and that was on Wednesday. In Johannesburg on Friday, they were down also 294.82. In Bombay on Friday, they were also down for 72. In Karachi, they were down 147.65. In Lahore, 140.11 in the negative. In Colombo, 48.99 in the negative. And on Wednesday, out of Tehran, 576 0.90 in the positive. The only positive thing we've had here is in Sydney. They were down on Friday 19.40 in the negative. The Nikkei was down negative 69.38. The Hang Seng was at 129.37 on Friday in positive territory there. Also in Shanghai, they were at 61.41 in the positive territory there. In New York, more of the same. On Friday, they were down 167.65. The Nasdaq down 45.80. The commodities market and mercantile out in Chicago was down 21.06. In San Pablo, they were down on Friday 82.51, and in Mexico they were also down 396.02. A quick look at commodities. We'll get to look at the oil crisis. Incidentally, the jackpot in the U.S. For something called Powerball is at 900 million now, and it could be at $1 billion. Lines all over the place. Nonetheless, Brent crude futures on Friday were down 41 cents at $33.34. Let me get and on the spot was down 50 cents, at $34.02. This is an interesting phenomenon here. Texas Intermediate crude was down 33 cents at $32.94. T-Boone Pickens is still jumping for joy. One of the things that's happening here is West Texas crude is now matching or very close to the Brent crude futures. So this is what we're seeing more and more of. Cocoa was up $54. And cotton's down 3 cents. We won't mess around with it. The Forex gold futures index was up $1.45 at $1,097.45. And we'll now go to the Euronext light futures. We've been doing those. Cocoa futures up $42 there. Robusta coffee futures up $4, and white sugar fell $7.80. The Bloomberg Commodity Index on Friday at 76.37. It was up 0.04 there, and actually 4 cents, 4 cents, so it was $76.73. Yeah, or 0.1% if we want to go with percentages. Now to the income inequality part of this scenario here. Wait a minute, we'll get it in a minute here. By Dr. Bloom and Company, Nicholas Bloom, Song, Price, Elot. This is a discussion paper. It was in May, but they delivered it at the American Economics Conference just recently here. In other words, the abstract. Earnings inequality in the U.S. has increased rapidly over the last 3 decades, or 30 years. But little is known about the role of firms in this trend. For example, how much of the rise in earning inequality can be attributed to the rising disparity between firms in the average wage they pay, and how much is due to rising wage disparity among workers within firms. Similarly, how do rising inequality affect the wage earners of different types of workers working for the same employer, women versus men, old versus young, new hires versus seniors, and so forth and so on. To address this, we began by constructing a matched employee data for the U.S. using administrative records covering all firms between 1978 to 12. We show that virtually all the rise in income disparity between workers is accounted for by the increased desperation in the average wage paid by employers of these individuals. In contrast, pay differences within employers have remained virtually unchanged, a finding that is robust across industries, geographic regions, firm size groups, etc. Moral wage gaps between the highly paid employees within these firms, CEOs, etc., and the average worker have increased a small amount, refuting the often made claim that such wide gaps account for large fluctuation of rising inequality in the population. We disagree. Anyway, nonetheless, different papers will say different things, and this is the Center for Economic Performance of the London School of Economics and Political Science. The dramatic rise in wage inequality since the 70s is in the U.S. has been well documented. Enormous bodies of theoretical empirical research have been conducted over the past 2 decades in an attempt to understand the cause of this trend. While much has been learned from these analyses, several major questions remain unanswered. As with any paper, you have to have new questions. An important set of open questions concerning the link between wage inequality on the workers' side to trends in the behavior of firms and industries that employ the workers. A major difficulty with studying a question of this sort has been a lack of comprehensive matched employee data in the U.S. that covers periods of rising inequality since the 70s. In the absence of comprehensive evidence on wages paid by workers, it is frequently asserted that the inequality within the firm is a driving force to increase overall inequality there. The growth of chief executive earnings and compensation, that is from Thomas Pickney, agrees, noting that the primary reason for increased income inequality in recent decades is the rise of the supermanager. To address these questions, we use data on wage earners from 1/16% representative of a sample of workers and 100% population of U.S. firms between 1978 and 2000. Wage earners have no top coding, which allows us to study individuals at the top of the earning distribution. Because it's based on administrative records, there's little measurement error, according to them. And this was basically using employer ID. Now, and this is the point, and we'll close this out. One key difference between this study and our paper is that we focused on populations of firms as a measure of employer by the employer ID number, EINs, as opposed to establishment plants in these studies. This is important as it allows us to study various questions about pay structures within corporations, including corporate headquarters. Second, our data is top-coded, which allows us to examine CEO and executive pay, since we look at divisions up to 99.9%. So this is some of their methodology here, and the main source of data in their paper, the master income file, is the confidential master income file, and it is compiled and maintained by the Social Security Administration. So several other studies have used that. Contains a separate line for each individual that has been issued a Social Security number. and so forth and so on. Let's get down to the conclusion of their study here. Hopefully we can get it up here. It'll take a minute to get it. But anyway, these studies will go on and on and on, and what we'll attempt to do is get several of them on the program so we can start to compare some of the studies, and I know why this is going wrong here. It'll take us a minute to get all of this in here, and we'll get down to the end of this as soon as we get it up here, and we are there. Some of the notes here this is more on how they did the study, and we'll finally get there. Well, we're just about there. This is some references, and the next step in the research project is to undertake a more detailed analysis of worker movement across firms and to use census and compute stat data to understand the movement of plants and firms. In other words, this is a working paper, is what it is. Conclusions: most Americans earn the vast majority of their incomes as wages in a firm, but there is a little research attempting to understand rising income inequality within the context. This paper attempts to bridge that gap. Firms appear to matter, although individuals in the top 1% were paid much more than the top 1% in in 1982. There's no doubt about that. We'll have some additional comments on this paper. We originally started this out is from the New York Times. Economists take an aim at wealth inequality. This is by Nelson Swartz. This was on the 3rd. And they mentioned the Mark Zuckerbergs of the world, etc. And then the papers presented by Bloom and Company, examining 35 years of data from the Social Security Administration. Now, Bloom is a right-wing economist. He's at Stanford, and examining the underlying dynamics of income inequality. It is much bigger group than outpacing everyone else. No doubt about that. And then several other texts from it. Professor Dr. Pickney, we had his paper there. And from the Center for Economic and Policy Research, we've had some stuff from them. So we'll continue in ongoing broadcasts exploring this. And we'll put this in the show notes where you can look at it. Unless we ran a little over, but we'll take care of this in editing. Good day. And for those of us, start over again. For those in business, make it a productive week. It'll be a full week. Holiday season is now over, at least in North America. And for the consumer, evidently looking at some of the final numbers during the holiday season, you were very prudent in your purchases. And some retailers like Macy's were not doing well, so they're going to make some redundancies. We didn't get to Macy's and their redundancies, but we'll probably have a special program and get to that. Good day.